Good evening, everybody, and welcome to our third class in our Getting Started 2 series. We're calling this class the Contenders because we're going to talk about real stocks in real time. This is also a Two Guys presentation, and that's our Two Guys logo down there. For those of you too young to recognize the Blues Brothers, those are the Blues Brothers from Saturday Night Live, and that skit has to be, I'm going to guess it's more than 20 years old because I was watching the Blues Brothers when I was still working, and I've been retired for a long time.
It's a lot
Yeah,
more than that.
yeah. So we've been using the Blues Brothers as our icon for these Two Guys skits, and we've been doing these Two Guys programs now for about 20 years. It used to be that in Better Investing, you never talked about real stocks in real time, and one day some young guy that was running a convention said, why can't we? And I didn't get a really good answer, so I said, we're going to. And we started doing Let's Talk Stock, and we started doing Two Guys presentations, and it's been a convention staple ever since. And we run around to chapters all over the country, and we find everybody's doing Let's Talk Stock sessions now. I think it's a great thing to do, and we've never had one bit of trouble with anybody in talking about real stocks in real time, as long as we do a proper disclaimer. So here's our proper disclaimer coming up right now, Mark.
Okay.
And our disclaimer is that this is an educational demonstration. We're going to be looking at stocks that we might own in our own portfolios or in our club portfolios. We're going to be talking about the par values, and these par values, of course, are based on data that were derived from lots of different data sources. Some of them might be data that we've come up with on our own when we have done an SSG ourselves. We're not endorsing any of the recommendations. We're not saying that Manifest Investing or Better Investing endorses any of these recommendations. Basically, we're asking you to do your own homework, and we're asking you to review and analyze the company and draw your own conclusions. Manifest Investing is not an endorsed product of Better Investing. They're not joined at the hip. They're not related to each other. But the Mid-Michigan chapter feels that they're both extremely useful sets of material and sets of tools that help us study stocks in a much better way together rather than apart. With that being said, if you'd like to be invited to our monthly roundtable, send an email to ncavula1@comcast.net. That's my wife. She will find a way to get you onto our Mid-Michigan guest list, and we'd be happy to add you to that guest list. We have almost 2,000 people now from across the country on the guest list, and we send out one email a month reminding you when our roundtable is going to be and giving you a link where you can register for the roundtable if you wish. We're going to talk more about the roundtable during this session tonight, so we can remind you again that ncavula1@comcast.net will help get you on the guest list if you'd like to be reminded about those sessions. They usually occur on the last Tuesday of the month, but we reserve the right as a chapter to move those whenever we need to move them. If you have questions about tonight or about the first two classes in this series, that's my email address and Mark's email address. Feel free to communicate. We got a lot of communication about yesterday, some of it very, very nice, and a lot of it asking really good questions. We're happy to answer those questions, and if you'd like copies of the slides themselves, then send a note directly to mark@manifestinvesting.com, and Mark will make sure you get a PDF of all the slides. We covered earlier at our chat during this session, but if you weren't here, you can find the sessions with the commentary and the slides on the Manifest Investing Roundtable YouTube channel. And you just have to go to that YouTube channel. It's already posted, those from last night, and the 2 sessions tonight will be posted by tomorrow. And we'd love, if you're new to that channel, for you to subscribe to the channel. When Mark and I started this, we felt we were going to be lucky to have 10 subscribers. We're up to over 1,100 now and counting. So I know it's not the million followers that a lot of the really pretty people have, but we think 1,100 is a pretty good number to have, and we'd like to make it 1,200 in the near future. So subscribe if you haven't already. Go on, Mark.
That just makes us a tiny bit influential. So we're small influencers.
We're teeny weeny influencers. Okay.
All right.
So
hey, I threw this one
turn
in there.
over to Mark. Yeah, go on, talk about that one, Mark.
All right. So for those of you that sat out and waited for your 8 minutes of darkness and a couple hours of the eclipse experience, I found it interesting. I found it more interesting watching people and how they were behaving, especially in the media. But it's pretty hard to top this one. We often end our bull sessions with an image. This is our public service here today, starting this program with that's one of the better places I can think of to actually capture that image. And this one has to go down. This one is probably almost National Geographic worthy. Can you name the waterfall, Ken?
Is this Niagara? I don't know,
It
Mark. Is it?
is Niagara.
It is? Okay.
And that was supposed to be pretty much dead center on the totality path. Good stuff. All right. So we're going to.
Mark, I have to get a message to my wife from one of our attendees here, so I'm going to be offline for about 30 seconds, okay?
Okay. Well, again, we covered a lot of turf last night. We gave a whole bunch of different screening results. We thought we might dive into one or two of them and then just basically talk about how we might break it down and really find that candidate for further study. I'm going to do that with the session that follows here in a couple of hours because it led me to a company that our screening and our preparations for the screening stuff yesterday actually led me to a company that I should have been no stranger to, but as I discovered, there's a lot more than met the eye, and I'm really glad and grateful that we went there. So we're going to dive in a little bit deeper. So while Ken is out of the room, this is we actually have found this to be one of our community's favorite screens. We mentioned it last night. We did not show it, but the triple play is something that George Nicholson, and George was one of the founders of the National Association, and he basically launched some of the early investment clubs in what we now know as the modern investment club movement. But he talked about times like the mid 1970s, and for George, the late 1930s, and a little bit of time in the 1960s where the stock market got really rough. And he basically suggested that you sit back and you get out there and continue your shopping for better companies at better prices. Don't do anything differently, but in this case, really double down on looking for companies that have an inflated return forecast. Ken, did you have something you wanted to add to that?
No, I'm listening, and I think that you're right on the ball here, Mark.
Okay. So again, you want to find a stock price that's really been crushed, and or the return forecast has been inflated because of that damage to the stock price, along with the possibility of an expanding PE going into the future. And then combining that with a business that is either restoring or gaining health in the forms of margin enhancement or margin expansion. Those three characteristics are what you're looking for. He referred to it as a triple play. He couched it in some type of University of Michigan football jargon, but he basically said these are the type of companies you want to be looking for. We made a presentation on this at a regional conference a few years ago in Lansing, and the companies that we actually trotted out and reviewed with the audience went on to do extremely well, incrementally better than the average stock coming out of that particular time. So Ken, anything else you want to add to this?
No, but I think people are interested in how they can find this list of triple play, and I know that's the next 3 or 4 slides. So why don't we move to a couple of different ways you might be able to come up with triple play candidates?
All right, so one of the stock screens that's built in at Manifest is to actually do a toggle. And as you're looking for stocks to study or consider studying, you actually just toggle it to, yeah, I want to see some triple play candidates. Okay, so what you're going to be looking for is what we just described, an elevated return forecast, a potential for PE expansion, and that would be from the current PE to the projected PE down the road, and then also an improvement in profitability. And doing it today, you end up with this list. Now, I want to caution the audience a little bit. We're going to actually show a demonstration of this. Um, this is a binary search. It's basically asking, is A greater than B, or questions like that. So if A is 1.01 and B is 1.0, you get a yes. So you can actually qualify just by simply meeting that true false criteria. And sometimes it's just marginally what you would think of as a triple play. You'd really like to see, basically an increment between the two conditions as you go searching for these things. But this is a pretty decent list. Going down the list, you're going to hear more about some of these companies. Inter Parfums is going to be presented later. Um, Diageo's been a recent discussed stock at the round table. Comcast is one that Pat Donnelly's shopping right now. Montclair was a recent roundtable selection, and it's related to Inter Parfums. Um,
Well, so was Iratum at a recent roundtable
and,
stock mark, the
and
first one on the
Radaman
list.
right at the
Yeah,
very top, yeah, and that's the one we're going
yeah.
to look at first.
I think we should make the point, Mark, that with any screen that's being used, you don't necessarily check all the boxes to make it something that you want to end up buying. This particular screen is looking for some very specific things, and then it's asking for a high quality. So that's exactly what you're getting. But you might not be getting up straight and parallel. There are a lot of high quality companies that have a decent par attached to them that are not up straight and parallel, that don't fit the basic model that the SSG was built to evaluate. So just like with any screen that you're going to use, it's important that you understand that this list is full of candidates, and you don't necessarily deal with something that's a candidate as something you want to buy until you check out and find out whether the candidate actually can actually win the primary elections. If I want to make some kind
Careful.
of an analogy, if they can win the primaries, and then if they can get through and become an actual contender for whatever the prize happens to be. We have some things on here that I am not real happy with. I know. I don't know if I would be studying companies that are growing as slowly as a few of these companies are. Um, I'm looking at Camden National. That's a bank. I'm looking at SS&C Technologies. That's an application software company. Those are kind of slow growers for my taste in my portfolio. Mark circled a really low EPS stability, and what that means is that EPS line is going to be scattered all over the graph. It's going to look like a roller coaster, and a really good roller coaster, rather than one of these nice straight uphill sloping lines that indicate consecutive and consecutive years of growth that's going to be happening at the same general rate year after year after year. So these are candidates and not
Yeah,
necessarily contenders for your portfolio.
and I think if you're relatively new to investing, anytime you see a, a visual analysis on a company like Diamondback, again, it's in a very economically sensitive or cyclical industry. So for a beginner, you might want to pass over that one until you've got a little more experience. For those with experience, if you believe that the price of energy and the price of petroleum, et cetera, could be headed in the other direction, this can be a very lucrative area to be in. You got to know what you're doing though, because the prices can move very suddenly and can can really cause you to lose some sleep. So again, beginner might want to avoid it. If you're a person that can stand that sort of thing, I'm not very good at that type of thing, but there are people that do fairly well in that realm. So here's a look at the first one on the list, Iradimen. What the first thing you're going to find is it doesn't have a value line report. So you can't do the typical thing where we just circle them and move on. You have to look for some other information. So in this case, what I've illustrated for you here is how this one is a bit of a marginal triple play. It certainly qualifies, as you can see over here on the left, with a projected return of 20%. But as you look up here at the profitability, now it is improving. It has been higher in the past. You can obviously say, well, yeah, that's in the right direction, but it's not very dramatic. Is that fair to say, Ken?
I think that's very fair to say, Mark, and I also think it's very fair to point out this is a very small company, and it's just recently began to mature to the point where it's gaining a little bit of interest among the investing community, and where it's also beginning to settle itself down. This company is so small, in fact, that I probably would kind of discount anything maybe before the last 3 or 4 or 5 years as being just really what do I want to say? It's something that a very small company has a great deal of difficulty in the beginning controlling things like profit margin and debt and things like that. And you have to give it time to grow a little bit before it finally settles down. It does look like Iradimed's margins have settled, and they do have that slight upward trend to it, which I really appreciate. I like to see that one long-term operating margin number that you've been able to reach in some database somewhere has shown nice growth for operating margin. I think that's a really good thing to watch. And the thing that I like to see on these small companies is the maturing of the PE value. Small companies many times are, the very small companies are the ones where the PE is many times kind of senseless. It's up many times in double digits, up in the 40s, 50s, 60s, 70s, places like that. And you can see in 2022, Iradimed's PE was up over 40. In fact, it was there in 2021 as well, and in 2023. This is the average PE we're talking about, folks. And when they get above 40, that really kind of gets me a little bit queasy in the stomach. But as the company is growing larger, the PE is beginning to settle itself down. And it's down to an average somewhere maybe in the low 30s right now, and I think it'll be headed even lower. If you want to see a great example of PEs settling down and becoming realistic, I would suggest you take a look at the last 10 years of Amazon's PEs, and you'll see a very real trend downward towards very reasonable PEs, which value the company at numbers that don't make you want to turn away from the stock.
Yeah, this is the type of company you want to try to understand. First of all, they make non-metallic, non-ferrous devices that operate in CAT scan and MRI type environments. And they have people that are pretty well leveraged into the business. So you just want to understand how do they propagate sales and that sort of thing. Again, it's a bit of a mission, but it can be, this type of company can be very rewarding. We're going to talk about medical devices a little bit later when let you guys pick on me. All right, here's another one from that list that happens to be covered by Value Line. So it has our traditional quick once around the park look at a triple play. So Maximus definitely has an elevated return forecast. We'd be looking for something in the, let's say, 15 to 20 range up there on the upper left. So the green arrow is basically a check. We're also looking at a situation where the company could go from a PE of approximately 15 to a target of about 18. And I find it refreshing that, as Ken said, this is a mature company, and they seem to percolate in the high teens. So that's not an artificially high number to shoot for, but it is a step up from where they're at now. And then you can also see that the company has been under some duress. There is some new management and some client turnover here, but a company that has been down in the 9 to 10 range is projected to get up to 12. So this one is a closer to qualifying as a classical triple play, but it is a company that has some challenges. You'll often
Yeah, and
find
I
that with. Go ahead, Ken.
and and since Value Line gives you not only operating margin but net profit margin as well, when you're doing that margin check, check them both. Make sure that they're both kind of in sync with each other, and that they're both showing the fact that you can see some increase from one to the other. And going from the 4s and 5s up to 7.5 in the next 3 to 5 years really gives me a nice warm fuzzy feeling. Maximus, by the way, is a consulting kind of a company that helps governments deal with lots of health programs and insurance kind of programs. They do a lot of managing programs for city and state and federal government programs. So it's a really interesting company. I think it's been a company, a community favorite off and on for a number of years. It's gone to its price has spiked sometimes, and then it's moved back when it's become very affordable. So
I
I would take a good look at this company. Yeah.
I will tell you, them in the state of Michigan, I'm 90% sure that they were involved in our Secretary of State driver's license offices, where you go to do all your business with the Secretary of State. And man, oh man, did they ever get that one right in terms of making appointments and using your cell phone. And we used to have to sit there for a few hours waiting in line, and that is no longer the case. So I might send them money just for that, Ken. I mean,
They also have a lot of business, Mark, with childhood programs, children's
right,
insurance
right.
programs, and things like that, and programs that deal directly with young folks. So it's a very interesting company to study. I would put it on a short list to take a look at. I don't know if it's a buy right now or not, but I think it's definitely a triple play, and it's definitely an interesting company.
No doubt about it. So earlier today, Ken issued me a challenge. He said, "Can we do a triple play using the value line screener?" And it's a little bit clunky. I want to play with it a little bit more. Might even do a YouTube video or make it as part of a future bull session. But I was able to do it, Ken, at least using the low total return forecast to give us some companies to look at, and this relative PE ratio, which is just simply the future average PE divided by the current. So anytime that's above 1, you've got expansion. And then I basically had to go and look manually for the rest of the companies. But let me kind of walk through this. I just picked 12. You could easily pick, 10, 11, 15, whatever your fancy is. And you get your first cut at a list of companies. And the companies over here on the right, they are sorted from highest low total return forecast to lowest. So anywhere from 23 down to 12. And it's actually a fairly short list. I think it's a fairly good list. How many of the companies actually have a PE ratio projected expansion? Well, you can see the numbers here. Some of them are actually a little bit high. It's kind of interesting to look at that. But uh, that narrowed the field down a little bit. And then the operating margin, all I could do was stack these two up against each other. They didn't have any type of a metric. I'd have to build that or do some spreadsheet gymnastics. So literally, I just listed the current operating margin versus the 3 to 5 year uh, estimated operating margin. And obviously, we're looking for the one in the last column to be slightly higher than the one in the second column from the right. So these are all qualifiers. It's a pretty decent list of companies, Ken. The blue arrows are the companies that are either A plus plus, or A. And that's probably
Well,
where more I would begin looking anyhow.
the math teacher in me, Mark, is in love with that second one there. I didn't realize that Value Line was going to give you a relative PE ratio that you could play with. I'm going to take just a moment to try to explain that in simple English to the math phobic people in our audience, okay? A relative PE ratio is nothing more than comparing a relative anything is just comparing two numbers, one to the other. And if we want the PE ratio to expand, then we want the future PE ratio to be bigger than the current PE ratio. And when you turn that into a fraction and put the bigger number on top and the smaller number on the bottom, you always get a fraction that has a value greater than 1. So what Mark said was, let's look at that fraction from 1 all the way up to 3 1/3, and let's see what we get when we're all figured out, when we're all settled out. I was really happy to see that idea in the value line screener, and I see what you did now on the last two is nothing more than print them in the table and ask us to do the comparison for ourselves then, right?
Yeah, I just went down the list and I removed the ones that were where the operating margin in the future was lower than the current operating margin. So
Excellent.
that's how I did it.
Excellent. Excellent. Yeah. And
Now
you
that
can get Excel to do that work for you too, can't you?
I did.
Yeah, I
So
figured you did.
I mean, Brown Forman, pretty good study. Goes very well in a industry study of Diageo, and then I'm sure many of us would like to do some field research on the rest of the companies in that group. But I'm kind of pleased with this list. Probably won't be the last time I do something similar to this.
I like to see a big drug company on this list. I just recently made a small purchase for one of my relatives and for my wife's IRA of AstraZeneca. So I'm extremely happy to see it appear on this particular list here too.
Yeah, it's
This is not an American drug company. This is a European drug company. But it has quite a pipeline attached to it. It makes for a really nice study. I'm going to give you a George Nicholson quote, folks. Never study a stock in isolation. So if you're going to look at AstraZeneca, make sure you look at 2 or 3 of the other big drug companies along with it to get a rough idea of where it stacks up with its competitors. 2 great competitors to maybe take a look at would be Novo Nordisk, that's another European drug manufacturer, and Eli Lilly, that's an American drug manufacturer. They're all 3 coming up on a lot of the screens we've been looking at in the last day and a half.
yeah, good stuff. And of course, many of us are out there cheering for AstraZeneca to perhaps take ownership of Ardelyx. It has been mentioned as a possibility. Okay, so there's my Churchill Downs, by the way, Ken. So
I see it, Mark.
all the grief
I'll
that I
tell
took after the round table, I don't know.
I'll tell you, Mark, when I first got involved with manifest investing, I was really interested in the trucking industry. I still own a trucking stock from way back when we started Manifest 20 some odd years ago. And at that point, Heartland Express was one of the most interesting trucking companies out there. Today, I like Heartland, but I love a couple of other truckers. That's another interesting study to take a look at. Some of the trucking companies today and what's happening in trucking, and then a related industry is logistics. Those 2 industries have some really decent candidates, and you might want to take a look at those 2 industries.
Okay, so let's take a quick look at the number one here also, PayPal. It's a Kim Butcher favorite. Again, they've got value line coverage. So you can see on the upper left, these are definitely, and again, Kim talks about this quite a bit, um, hoping for a turnaround with this company. You can see the incredible decline in the stock price from 300 to 50. And that, of course, will shake out a lot of the investors in a company like this and scare other ones off. But the return forecast is elevated. The current PE is approximately 16. We note that they're looking for almost a double. That compares pretty well to what we see here, depending on when that data was actually taken. So about a double from the current price to earnings ratio to the 3 to 5 year PE ratio. And last but not least, sticking with the net margin category down at the bottom, again, we see that they bottomed at 9. They were in the mid-teens. So anywhere in that mid to 13 or 14% range and expanding out to 17. So again, that's consistent with the type of expansion that we see here in the operating margin going from 19 to 23 and a half. I think Value Line is actually looking at this number versus this number. I want to take a closer look at that. But anyhow, that is margin expansion expected. It's certainly
I'm going
not
to take
unprecedented.
I'm going to take a small step into the weeds, Mark, before you get off this value line page and just look up there at that PE ratio at the top. That's kind of a strange PE ratio, and I'm not going to try to explain where value line gets it, but the trailing PE, which is in parentheses right next to it, it's 19 on this sheet right here. That's the traditional PE that we use and that many analysts use to evaluate the PE of a stock. Many analysts either use a 4 quarters trailing, that's trailing 12 months, TTM, like we've been talking about, or a lot of analysts also talk about a forward 4 quarters where they use their estimates to figure out what the PE might be going forward. But that 19 is the traditional PE that we talk about in Better Investing, and that 19 still is nice appreciation, nice growth up to that 30 that they're predicting out there in that 3 to 5 year column.
Absolutely. So again, the point is, this list will basically lead you to a couple of pages that you can file through and rifle through and look for these conditions, and then you can make your decision about what you believe about the company. I happen to think that PayPal is pretty well leveraged and in pretty good shape with all of their product lines and Venmo and all the stuff that they do. Yeah, and they are under new leadership. It'll be interesting to see how they deliver going forward. A little bit of good news will probably go a long way with this company. All right. Anything else on this, Ken?
No, I think we beat this one to death real nicely. So let's
All
look at
right.
all my friend here.
Jack Palance.
Jack Palance you didn't capture his horse though, Mark, you know?
No, no, not in this one, but or Billy Crystal. But we've done this a few times, and we're basically going to spend just a couple of minutes talking about, and again, more with community newcomers and novices in mind. Uh, what is that one thing that you think about that you think would be important to share with somebody who is attempting to engage this experience of long-term investing? So here is our roundtable, and the reason we bring this up is we think this is a fantastic community demonstration of some different styles of stock picking. Is that fair to say, Ken?
Absolutely fair to say, Mark.
And it's not a flash in the pan. It is now 14 years, and we're coming up on our 14th year now. So, do you want me to explain this one, or would you like to take it away?
Well, I'll do part of it and then turn it over to you. How about that?
Okay.
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 Uh, this is the most recent graph that we put up. This came from the end of the month last month, the end of March. So I'm looking at a 16.2 rate of return since inception. That's up there in that dark blue background box, 16.2%. I'll tell you, folks, I would take that return. I don't care how it compared to anything. I would take 16.2% over 14 years, no matter how you handed it to me. The Wilshire 5000 has done better than the long-term average over that same period of time. The market's had a pretty good stretch of performance over the last 12 to 14 years as well. And the Wilshire 5000, that's 5,000 stocks in the index, has measured 12% based on the same kind of additions and subtractions of cash in the portfolio. That gives us a relative return of 4.2%. In English, we beat the market by 4.2 points. Our goal over time is to reach that George Nicholson goal of beating the market by better than 5 points. So we're a little bit under the goal right now. The goal is on the dotted line, and you can see for an awful lot of the time we've been bopping and weaving above and below that line. And for a lot of the time since our 7th year of existence, we've stayed above that line. We've beat the market by more than 5 points. We're a little bit below right now, but I have confidence we're going to snap right back up again. Why don't you pick up whatever I
I
forgot
hope
on
you're
this
right.
page, Mark?
Yeah, the weaker performance for the month of March was largely due to the Magnificent Seven taking a breather and stocks like Apple and Google not going up quite as much. And then also one of our largest holdings, Ardelyx, has taken a bit of a haircut. And that one is extremely volatile. So I also have hope that we're going to be restored there. So again, we're trying to beat the market by 5. We also have this accuracy goal where we'd like to have 55% of our selections basically beat the market. We're running pretty close to 50%. You can see down here. And if you can hit that 55% number, this is kind of the one thing on this slide that's a little bit elusive. The reference to Tillinghast is the manager of the Fidelity low-priced stock fund for the last 30 or 40 years. He's uh, an associate of Peter Lynch, and Joel Tillinghast basically said that if you can reach that 55% level, you'll do very well. David Gardner with the Motley Fools hovers at about 55%. So it's just something to keep in mind that you only have to be right 11 out of 20 times to generate these type of numbers. 11 out of 20 times. Now, it's a pretty good, high batting average, but it's something that can be done. And again, I just want to reinforce that this is a group of knights and damsels, and the audience gets a vote. Um, Doing pretty well collectively. Here's a look at the companies, just to give you a quick. We won't spend a lot of time on this, but this is the companies listed by their percent of total assets. You can see that our largest position is Microsoft. That Ardelyx position that I'm talking about, taking a little bit of a breather, that was nearly $10 a couple of months ago. It's down to 742. In fact, I think it went from 704 to 749 today. So pretty good day for we in the Ardelyx camp. But you can see a number of household names, and then another thing that we do take a lot of pride in, the fact that there's a number of kind of off the radar companies on here. I would cite even Axos, but Five Below, Green Brick Partners, Universal Display is not exactly a household name. And so in addition to those, um, there's also some pretty many of the Magnificent Seven are on here also. Anything else here, Ken?
Well, I just like to always point out that on this list of, and these are only the top holdings in the tracking portfolio, there's one of these companies that's a one-time only pick. We've only chosen Costco once in the entire 14 years, and we weren't even doing audience picks back when we chose Costco. So Costco was chosen, and that one Costco $1,000 investment is now $15,000. So our biggest mistake probably was not to repeat that Costco choice
Go
a
back and do
half
it again.
dozen or a
Yeah.
dozen times. Yeah.
Yeah. And Amazon's
The
only a two-time selection.
Exactly. And up at the top up there is the legend. You can tell how many times we've chosen them. And if you don't find a name up there in the legend, that means we've only chosen it once. So Microsoft, if you notice, is a 5-time selection. And that 5 times has grown to almost $107,000 now. That's $5,000 put into Microsoft, and it's now 107,000.
And
I think we have a slide that's going to really blow the hair off some of the folks
all
in the
right.
audience. Here it
And
is.
this is kind of one of our one things. This is pretty cool when you think about it. Again, going back nearly 14 years now, we've made nearly 800 selections. Every time we make a decision, we put in $1,000 into it. As Ken just said, that $5,000 in Microsoft is now over $100,000. So the rate of return, again, percolating around 16%. What we found when we went back and looked at the entire laundry list of decisions made, about a third of them, 278, actually have current or closed out terminal positions less than $1,000. So basically, they lost money, or they have unrealized losses, or they have realized losses. The sum of those actually adds up to about $72,748. Now, here's the one thing. I still get hairs on the back of my neck going up when I think about this. If you look at just the Microsoft 5 positions, The gains on that, in fact, this number is from a few months ago. It's actually higher than this now. It would actually now be what? 100 and let's go back and look. The gains in Microsoft now would be 100 and almost $102,000. So that's up from this number. The gains from that one position in the portfolio offset all of the losses for the 278. I'm pausing to let that sink in. If you think about that, this is one of the slides that I use, especially when I'm with some people that are a little bit fearful, see it as mysterious, approach investing with a little bit of trepidation. My question is, what are we afraid of? Is that
Mark
is
and
that
I and Mark and I and the folks at Bull Session have done a little bit of reading and a little bit of discussing investor psychology. And one of the things that we've discovered in doing some of our readings is that a lot of investors focus on the wrong thing. They focus on the negative. They focus on the losses in their portfolio. They're always worried about trying to deal with a loss, and they're forgetting that they have home runs. There's not a portfolio out there that doesn't have at least one home run in it, and a lot of portfolios in today's markets have 3 or 4 big home runs. And by home runs, I'm talking about a performer like Microsoft or Amazon or Nvidia or Google or some of the unknown stocks, and we're going to talk about that in a little tiny bit. They're not just the Magnificent Seven stocks. There's other stocks that are quite high on the performance list as well. And if you remind yourself that there's a definite amount of money you can lose in an investment, that's all of it. But there is no definite amount of money that you can make in an investment. And when you get a home run, it balances out so many of your losses that you should be focusing on your success rather than focusing on your loss. You'll sleep a lot better at night. And if you start to do a little tiny bit of arithmetic like we're doing right here, I think you'll be able to begin to convince yourself that while you've made a lot of mistakes as an investor, you might make a lot more as an investor if you're a nice, sane, constant kind of small amounts of money over long amounts of time. And if you let compounding do the work for you, you're going to end up in good shape as far as your investment portfolio is concerned. Now, I'm not talking about day traders. I'm not talking about speculators. I'm talking about good, solid, conservative sleep at night investors. And that's the people that we're talking to on a regular basis that believe that what George Nicholson said for our investing community was true in the 40s, and it's true today. So let's look at a few more slides and try to make that point, if you will. Mark, talk this one through for us.
okay? This is something we really like to remind ourselves much of the time. Um, for the right person and the person that does not want to get crazy about investing in common stocks, you can choose to invest in some form of an index. And when you do that, these are all pretty reliable, and there's nothing wrong with these numbers. But the answer to the unanswered question at this point is, why would we do this? And the answer is the numbers up at the top. These are not 7 companies chosen at random. These are the 7 most widely followed companies by our community. And the dates go back quite a ways. You can see that they're basically beating the market by significant percentages, and we'll talk about that here in a few minutes. The round table, again, is checking in here. That is extremely powerful, good performance. And then the tin cup demonstration portfolio, not going to spend a lot of time on it other than, especially if you're fairly new to investing, fairly new in your career, you've got a 401k. What this is what if you had invested the maximum amount into a 401k since 1994 and basically bought companies the same way that Walter Schloss, you're going to meet him in a minute, had done over that time frame, simply licking your finger, turning the pages of the value line for those of you that remember that, or those of you that punch a few keys on a computer and find the companies that meet the criteria that we're talking about. Um, Again, that's a demonstration of what is truly possible. The round table proves that a group of people can come together and do it also. So very powerful evidence. These numbers are incredibly powerful for these 7 stocks. Here's a quick reminder. This is the actual look at the value of Tin Cup over time. Yeah, it zigs and it zags. I can remember when this felt like the Grand Canyon, and now you can barely see it. Now we've got this thing to deal with going forward. But again, over the long term, we're actually up above 4.5 million for the first time. And again, this is if somebody had started in 1994 investing the maximum amount they could into a 401k and investing it in better companies at better prices. Rinse and repeat. All right.
That blue line, folks, is the line of reasonable expectations. And that blue line is showing growth on a normal Cartesian graph at about 10%, maybe 10, maybe 10.5%. That's the long-term growth rate of the stock market for many, many, many years. It's gotten a little bit foamy in the last couple of years, but long term, that 10.5 has held for a long time, and I expect that it's not going to change that much as we move 10 or 20 or 30 years into the future.
Yeah, it's a concept that was popularized by Jim Clunan at the American Association of Investors, and we just added it to some of our graphs. Well, here's a softball for Ken. This is actually from one of our 20 questions sessions. Do we offer any advice, or do we ever talk about the size of companies with respect to diversification? And you can see my answer there. Whoa, dude. We talk about this a lot. And Ken, go ahead. Tell us why it's important.
Well, everybody likes to talk about things are different nowadays, and the more I read about George Nicholson and what he asked us to do in these clubs and what he asked us to do as individual investors, the more I think about why the rules and the guidelines were put in place, the more I think that we have a hidden gem sitting right in our own backyard, and we need to continually go back to some of that literature and remind ourselves that it works, and it works really well. Way back in the 40s, Nicholson was telling us to do investing in small, medium, and large stocks, not to overlook all 3 categories. And he was saying large stocks, and he was talking about growth rates of sales. He was saying large stocks don't grow as quickly as small stocks in their sales. And that made perfect logical sense then, and it makes perfect logical sense now. Of course, you can point to exceptions to that rule, but for the most part, larger companies grow more slowly than smaller companies. And we can put a class in the middle and call them medium-sized companies, and they grow just right. They're like a Goldilocks company, if you will, right in the middle. And we need all 3 kinds of companies to put together a portfolio that's going to perform better than the market. The market performs at around 10% over time, 10 to 12%. But we're looking to perform 5 points above wherever the market is performing. And to do that, we should be looking at all 3 kinds of companies. Slower growing companies, which will give us stability, faster growing companies, which give us a little bit of a roller coaster ride sometime, but also give us that added boost of appreciation, and then the good solid workhorses in the middle, and that should occupy about half of the portfolio that we're talking about. Here it is written down in one of the better investing handbooks from the mid 80s. We think that this handbook is good then, and it's good today. Read it if you can get a hold of a copy of it. The handbook had a couple of different iterations in the 90s, and some of those are out there. Some of this literature is the same. Some of them have been edited and altered a little bit. We happen to think this was the last handbook that Mr. Nicholson had a direct part of dealing with as an editor, and we think that it represents his thinking more than any of the other literature that has been put together before or since in the organization.
Yeah, to me,
Um,
it's to me, it's basically George sat down and says, "I've been doing this for 50 years. I've got some thoughts to share." I take that pretty seriously. One of the other things that sets us apart from the rest of the world, and it's an area that screws up Wall Street all the time, is we don't use this at all. No caps. And in fact, one of the nuggets that I could give Jack Palance is small cap is not necessarily small company. Chew on that, understand the difference because it's extremely important. And here's where it actually comes home to roost. This is what we mean by all of the above, that blend of small, medium, and large companies, because you're looking at two numbers here. The blue line is the Vanguard Index 500. That is the S&P 500. That is all large companies. Now the lost decade is in there, so it kind of messes it up a bit. But look at the difference between that and the value line arithmetic average, which, by the way, all of these blue companies are in that red number. So the difference, it can be attributed to the medium and small companies.
yeah,
It's a powerful chart.
I notice a question in our question box that says, shouldn't we be talking about earnings rather than sales? And my response is no, everything begins with sales. I think we fervently believe, in fact, in mid Michigan, we chant that earnings follow sales and stock price follows earnings. So eventually the stock price moves with earnings, but earnings have to depend on sales. Over long periods of time, those two growth numbers should begin to match each other. Sure, it's possible to have a company with lots of sales and negative earnings. There's hundreds of them on the stock exchange, but they're not the kind of companies that we would suggest that you invest in. It's just not true that you can listen to the companies they're talking about on television and build a coherent portfolio. First of all, our time frames are so different from the people that are chatting away on TV. Their time frames might be as little as 2 weeks or less than that even. We're talking about a 5-year time frame, and we're talking about growth stocks. We're not talking about stocks that have price to hope ratios. We're talking about stocks that have actual price to earnings ratio. We want to see our company actually earn something, and we want those earnings to be relatively consistent with the sales growth. There's a lot of companies out there, folks, where you do an SSG and all you have is a green line. Those are not the companies that we're studying.
Yeah, and the mantra is basically buy and hold, right? But it really is buy and hold for as long as it makes sense to do so, and that's what our studies and our portfolio management practices take care of. But as Ken said, we the 5-year window is for calculations. It's not necessarily even our target holding period. In our family club, we own stocks that we bought in the 1990s. So again, we're holding them for as long as it makes sense to do so.
And this ancient person over here, Mark, holds stocks that he bought and his wife bought in the 1980s. So
There you go. It can be.
figure that out.
I came out of a meeting of the American Association. In fact, a couple of the people at that meeting joined our investment club in Chicago. And when I explained that we had stocks that we had held for like 15, 20 years, and we had like 3 sell transactions in the last 5 years, they were just almost delirious. They had to see this to believe it. And they became very productive and participative members of our club. All right, so again, here's kind of another one thing that I like to point out for people who are relatively new. If you have a family member you're trying to get engaged, I basically tell newcomers to be a sponge. Soak up what you can get your hands on, whether it's videos or books. The books by Peter Lynch, The Motley Fools, the book by George Nicholson. Soak it all up. And then the other thing that you want to do is anytime you run into a topic or a phrase that's unfamiliar to you, uh, grab an index card, write it down, and go in search of an explanation. When you understand that, cross it off, and then just keep doing that with index cards as you go. There's a lot of jargon and nomenclature, and trust me, Wall Street does not do you any favors here. And the other point that I want to make is you don't need anything more than algebra. So if you end up with calculus on that card, you're doing it wrong.
And Mark, for those of you that are under 30, there's not very many of you in the audience that are under 30. We can substitute the index card and we can put the phone right there. You can keep it on your phone as
Keep it
well as
on
an
your cell
index
phone.
card.
Yep.
Yep.
I'm not going to tell the Nancy story right now. Here's that Wall
Okay.
Street guide that we mentioned. Again, you can leaf through the book and look for companies that meet what you're hunting for. And we make it pretty clear, better companies at better prices. And this guy, Walter Slosh, was an affiliate, a friend of Warren Buffett. He actually was in the desk right next to in the cubicle with Warren Buffett over a period of time. But he was a professional investor, I believe, in the Pittsburgh area for much of his career. And we love to make the point that he did it just like us. And the Value Line Investment Survey was one of his favorite sources of ideas. And he literally would grab that paper bound copy that used to come, well, it still does for some people, much like a newspaper, and leaf through it. Lick your finger, lift, and basically turn the pages until you see something that meets the criteria. This was his ladder of basically explosive returns. You can see for every point that you climb up that ladder on the rate of return, notice how the numbers just basically explode. And that's why you want to find resources and ideas and friends, share those ideas and move up and basically experience those gold bars.
Let me try to put this graph, Mark, in different words, okay? That boxed in number, that 10%, that's the market, and that's an index fund. So you can turn $100 into over $4,000 in almost 40 years by investing in an index fund. And that's a pretty decent return, 10% a year over 39
Yeah.
years.
In fact, the government
But
makes most people use this one.
yep, you're right. But if you were investing in the roundtable stocks, remember, we're returning about 16% annualized, and that's up there. Ask yourself, wouldn't you rather have something around the $32,000 mark than around the $4,000 mark at the end of your investing career, or in order when you're going to retire, or you're going to sit down and start using that nest egg to have all the fun that you didn't have when you were working? The chart basically is telling us what's possible and what's easy to do. And if you want to settle for what's easy to do, then settle for the 10, 11% returns. If you want to make a little bit better money, then up yourself to the 13, 14, 15, 16% returns if you can.
I mean, yeah, I mean, you're basically talking about being paid an incremental $28,000 per $100 to have fun. I mean, there you go. It's another nugget. All right, so we can go ahead and play around. I just wanted to use this as an opportunity to point out that we do archive these sessions. Last night's sessions 1 and 2 are already on the YouTube page. If you go to YouTube, just search on Manifest Investing, and you'll see our bull sessions and that roundtable. Here's our most recent roundtable right there. And as I've pointed out to a number of people, this is a pretty decent discussion on NVIDIA over here. All right, so Ken, what anything else in the hopper? We
Well,
are
Mark,
at
yeah, we
7.
had we promised Bill we were going to take a look at the heat map real quickly. Can you get there real quickly
I
on your
think
computer?
I think I can. If I can't, I will summon your assistance.
All right.
What I'm going to do is go to the homepage for Better Investing. I think I'm still logged in. I believe I want to click on that hourglass or that glass, right?
On the spyglass,
Yep,
right? The
the
spyglass over on the
spyglass.
right there.
And that
Yep.
brings up our screening page. And I'm warming up to this. I already said that. I know it's a pun, but I am warming up to it. I mean that is
I
basically
think what you want to do, Mark, is click on the heat map itself, and that will make it bigger.
okay. Any place?
I think any place,
Or
yeah.
do I want to pick my company for tonight? Is it here? I don't see it. Let's go NVIDIA. Ah, here we
There
go.
it is. Okay, uh, and the tour of the heat map, Bill, the map does change, not daily, but it does change week to week. And basically, it's capturing studies done by our community that have been saved in the tool, in the SSG Plus or in the Core SSG. And then it looks at the results of those completed SSGs, those that are favorable, and favorable would mean in the buy zone come green, and those that are in the sell zone come very red. AbbVie, for example, right in the center is an extremely red square. So I know that the results of those studies are basically sell. I'm getting a really big red square over on Fastenal over in the industrial section over there. And I'm getting some really dark green for InMode in the healthcare there, and then some fairly darker shades of green for a stock called Perry down in the communication services, and
No, I'm
for
gonna
some
foreshadowing.
foreshadowing, and for Paycom and ACLS over in the technology section right there. So that's how you use the heat map. It's just being able to spot uh, uh, companies that our community is studying. The bigger the square, the more studies are being done. That's the way you want to think of this. And then you use the color. The more green, the more it is a buy, and the more red going to yellow. Yellow's kind of in the middle, so you got to kind of keep that in mind. But the more red it gets, the more it is towards a sell. I like in the healthcare, we have Semler Scientific and Iradimed in a pretty nice darker shade of green, right next to PayPal and AX, which I think is Axos Financial. Am I correct, Mark? I
It
think
is.
so.
It is.
Yeah. Okay.
This
So
is
if you,
interesting. I mean, go ahead, Ken.
yeah,
I didn't.
well, and if you hover over the square like Mark's doing, then you can see the name of the company, you get the sector and the industry that it happens to be in. These are Morningstar sectors and Morningstar industries. And then you get the historical sales growth rate. This is actual data coming from the company itself, and it's historical data, the last 10 years growth rate for sales and for earnings. And then you see that there have been, in the last 90 days, over 500 studies have been created for this particular company. I hope that's enough of a wandering through the heat map to make you happy. Steve, did we have any more places that our audience would like to take us? We have maybe 4 or 5 minutes if you have something for us to look at.
Yes, while you're in the SSG Plus, if you have a portfolio that you could use, open up a portfolio report. Someone asked about a graph showing the size of a company.
Okay, I'm going to go to Mark. Can you make me the presenter, please?
Either that, or you can just steer me. It might be quicker that way.
Well, are you okay?
I'm in your. I signed in as you.
All right, great.
No,
Then in that
we have
case,
to swear the audience to secrecy. That didn't happen.
press the folder up on the top there. That will take me to my studies. Okay, and let's press the model club. It should be getting the portfolio right
Yeah,
now.
you've got a bunch of them here. Most of those heat maps,
Okay.
your studies.
Okay, no. And then press MMMC right there, highlight it.
Highlight that.
Yeah, just press on it. Uh-huh.
I don't see that it's okay. It
There,
is processing.
it just did, yeah. Okay, and then uh, what I'm doing is I'm seeing a listing below now of just the model club's portfolio, and right next to the letters MMMC up there where it says portfolios, Mark, if you can scroll back up again,
Okay, sorry.
there's a button, And that button gives us some different reports that are attached to MMMC. The dark blue button says reports, and if you
Reports.
click that, okay, and the first report that comes up is a report that my clubs use quite a bit. And you can see that I have not updated the prices in this portfolio. We have a meeting Monday, so I'll be updating the prices over the weekend. But this is a report we use quite a bit when we're coming down to actually spending our money, because it gives us a lot of information about our own SSGs, and it gives us our buy, hold, sell recommendations off in the far column. I think that they were talking about the diversification reports. If you look up near the top, there's three kinds of reports. Let's press diversification. And they're showing you different categories for diversification. This first thing is talking about sectors. Those are on the colored bars. And then the industries within each sector. And if you scroll down, that's in a graph form rather than in a chart form. And you can see right there that about a quarter of our portfolio is in tech, with about 18% of our portfolio in yeah, there it is, 18% in the financial sector. And if you scroll even a little bit further down, it breaks those pie shapes into the different industries. And if you float over one of the industries, you'll see that you get the percentages, and they're also called out on the side over there. And then if you scroll down even some more, you get the companies, and again, they're in their right color and they're in their right sector. But this time, if you go in the sector, it tells you which company is actually in that sector. So in this particular piece of pie, that's where Cognizant Technology resides. If two companies are in the same piece of pie, two companies will come up. I don't know if this club owns any pie shapes with two companies in it, Mark, but they're all there for you to look at. Steve, is that what the question was about? Do you think I answered it or not?
Scroll up to that drop-down menu where it talks about, instead of this report, it gives us a company size report. You'll see it at the top. There's a drop-down.
Yep, over right there. We can also look at size diversification. And is this the one they want to talk about?
Yep, that's the one. And if you scroll down, we'll see a pie showing, graphing out the size.
I will tell you that this chart is using the Better Investing numbers that we put in all of our classes, and they define sizes by a small company being something that sells in the most recent fiscal year less than $1 billion worth of product or services. So for this company, the orange piece is our small companies right up there, Technoglass and Semler Scientific. And then the large companies are those that are over 10 billion in sales, not dealing with any growth in sales, but just in the actual amount of sales. And then the blue piece is the medium size. This chart will be different than the chart you see in Manifest Investing, because in Manifest, we tend to look at size based on sales growth, not on the amount of sales in the last fiscal year. They're both measures that Nicholson gave us to use and to separate the companies into three groups. And I would not obsess over using one over the other. They're both useful at various times to take a look at. Does that help answer the question then?
Yeah, I think that's great. The size diversification and comparing the different companies in your portfolio for size.
Okay, and it's also telling you which companies fit in the different sizes and what percent of portfolio. You'll notice, folks, that this portfolio has some zero market values because we keep our pounce list on the portfolio list so that we don't forget. This is just saying we'd like to buy Paycom and we'd like to buy FactSet if it ever became a stock that we had money at the same time it was in the buy zone.
Well,
So,
couple of your club
yeah.
partners called me, Ken, and they're waiting to hear what Ann Manning has to say about Paycom.
Great, tremendous. Okay. So with all that being said, Mark, we're at 10 after, and we're going to have to get off and get ready for our next session. The stock panel is ready to go, and we have it all teed up, ready to go. So thank you for being here tonight, and we hope we see you in about 50 minutes at the stock panel. Let's talk stocks. Thanks, everybody.
Thank you, Ken.